Welcome back to the channel. My name is Brad and today is Sweet Tea Time. For all those new people, this is just Brad talking about the markets, where things might be going, some nuggets. I don't know. You never know what Brad's going to say. I mean, a couple weeks ago I was looking where this wire went and still haven't figured it out. But anyway, we're going to talk about gambling markets. Let's talk gambling markets. Gambling market is $11 billion in 2023. That's getting kind of big over there, and it's getting bigger and bigger. And I always thought cheese was made in France, but look at that. Germany is leading the way for cheese. Oh, wonder about that. Largest companies by revenue. Lots of big companies out there. Apple, Walmart, Amazon, JP Morgan Chase. You see the picture? Lots in Asia, lots in North America, some in the Middle East. I don't even know how to pronounce that. So, optimism in 2025. And this is going to be important because 2025 is just around the corner. And people in Indonesia is optimistic. Colombia, that's because cocaine is getting pretty good coming out of Colombia. Just joking there. China, you can see the stats. You can see that Japan and France and Belgium are the least optimistic. And because I can just go ahead and say this, that's because the French and Belgians are just not optimistic at all, anytime, even though it's a wonderful time. It is just how they are. It is. Sorry, Frenchmen and Belgians. I'll have to pay for that one later when my wife actually hears me say that. U.S. government agencies, highest paid. Securities Exchange Commission, $227,000 median salary, and they got 4,993 people. Interesting. Interesting how much they're getting paid. Fear and greed. Stock market is still 23. Well, this is going to bring me to my first little conversation. Sideline. Somebody said the other day, it's surprising that YouTubers think that they know more about how the funds should be running than the funds. And my comment is the SEC should make sure that their prospectus tells us exactly how the funds are going to be doing, or they don't deserve their $227,000, because the SEC is there to protect me and make sure that these funds are telling you exactly how they operate. Because if you don't know how they operate, then there's no way that you know if you should be investing in them or not. Seriously. If you can't read the prospectus and tell how that fund is going to be running, then you probably shouldn't be investing in it. And if I read it and I see that it says refer to section, I'm just going to say yield max and feet, refer to a section that didn't exist. It was not there. They said refer to this for more details. And guess what? It wasn't there. Surprise, surprise, surprise. And the SEC let that go. I think SEC should be fired. I think I should report that. It said, I want to know where that section is. It's reasonable. I don't think it's unreasonable. I think if it says refer to section 8 and it only has 7 sections in it, the SEC did not do their job and they don't deserve that $227,000. Just throwing it out for conversations, because they are there to try to protect you, and they're not doing it. They're just letting it go. Since I brought up feet, let's talk about feet. So, Dorsey Wright. I went out and started searching more funds about Dorsey Wright. And I kind of like what they do. But I will tell you that if I went to Invesco and look at the Dorsey Wright funds or stocks that are in there, not the same stocks that they have at YieldMax. Kind of pointed that out. Interesting that Dorsey Wright uses point and figure. Really, it's point and finger, because all they're doing is pointing. It's point and figure. They're supposed to be doing that at Invesco and at YieldMax, but somehow they're picking different stocks, calling it as it is. If Dorsey Wright is using the same algorithm, which they say that they are, point and figure for YieldMax and for Invesco, then you should see the same stocks and show up in both funds, and you don't. That is the moral of the story. It is just marketing. Just marketing. Nah, I think they're good. They picked good funds in there. They picked a, I had 4 out of the 5. I don't think that you need to pay them an extra 0.28 to get the same funds that you could do for free. Just let's get a little more money out of these suckers, and we'll just squeeze them a little bit more. Interesting. But some people will defend them to the hilt. Don't get it. Don't get it. They're literally stealing money from you, and you're going to just defend them to the hilt. On that conversation, Stephen's forum the other day, somebody actually brought up YieldMax. And I am going to respond to that person later today. And I can tell you, off the record, Jay told me the only fund that he recommends for retirees is YMax. That's right. Jay said it himself to me off camera. Just thought I'd throw it out for conversations, because if you're a retiree and you think you're going to play all these different funds, I know we all have that maverick in us. We do. We really want to be that maverick. Just be careful, because Jay himself actually said, hey, I can only really recommend YieldMax for retirees. Just conversation. I don't get it. Oh, that's right. Sell everything by Misty. I'm sorry. And I'm not going to even edit that out. I'm just going to let it go. So also I noticed on Stephen's conversation, and there's been a comment down below a couple times about where should I stack my cash. And I just throw my hands up and say, really? And my conversation is that, hey, I can make 4.5% at Fidelity, and I can have my money same day. If you're willing to wait a day, and it's literally T plus 1, means you trade on one day and you get your money the next day, you might think about Mint, JAAA, SGov, JBBB, or Clause. I'm going to say when you go to JBB and Clause, just be a little more aware that there is some more price fluctuation. But the rest of them, you can see the prices are very steady. Just showing you the graph of what you may or may not want to put your money into while you're waiting. Now, personally, I can trade. I can sell. Let me try to explain this. I can sell one of these funds and trade it the same day. So if I had Clause, which I do, I can sell Clause and trade those funds the same day, but I can't withdraw those funds on the same day. I have to wait to the next day. Not a big deal if you can plan. Just not a big deal. If you can't plan, which a lot of people can't because all they can do is weekly, which we're going to talk about here shortly, is you might want to choose one of the others that you can get to your money readily available. But most of us can wait a day because we have credit cards and other things that we can put expenses on and then just plan out our lives. Now, I really thought about weekly the other day because everybody's into these weekly ETFs. And I started thinking about this because I still listen to Dave Ramsey when I get a chance, when I'm not making content for you guys, right? So I think it has to do with the snowball. I think it's all psychological. I really do. I think it's psychological in your head that getting money every week, it's a psychological hurdle. just like the snowball effect when he tells you to pay off your debt. I think that's an interesting conversation. I think it's when you get into this, it's all psychological. And money and dealing with money is a lot of psychological anyway. But those are my thoughts on where you could hold your money, weekly psychological. Let's talk about clause real quick. Because somebody the other day and said that, hey, the CEO changed and blah, blah, blah. Fear and uncertainty. Did you know that they were actually owned by somebody else? So the guy that took over was actually that guy's boss to begin with? Yes, he had the title of CEO and he was the founder, but they were owned by somebody else. Just like all big companies and big organizations. So the fear and uncertainty shouldn't be there. I kind of pointed out that, hey, I went through a lot of CEOs over my lifetime. CEOs direct the boat a little bit, and I'm going to point out when that guy was suddenly gone, you see a jump in clause and you see it become more stable. Just throw it out for conversations that, yes, he's gone, but the charts say it might have been a good thing that he's gone. Don't know, and you never know. You know if it could be, and I'll personally tell you, I left because I didn't like the CEO of a company. I didn't like the way that he was driving it. I think that he did a good job so far, a couple years after I left, but they changed the way that the company was ran and how they treated employees. So I left. That was my choosing. If you don't like something, if you don't like a fund, leave. Sell it. Just because I hold it or somebody else holds it or Steven holds it, sell it. If you don't like it. If you're going into retirement, and I saw a comment the other day about this. If you're going into retirement and he was 3 years out, I strongly recommend 5 years out starting to get your feet wet with income investing, if that's what you're going to do. Growing pains, figuring out which fund is which, finding out your style, finding out how much money you need. And there's nothing wrong with GPIX, GPIQ, if that's your style. It's not my style, but it might be your style. And we all have different styles and we all have different perspectives. Maybe you're only trying to live off of 6%. And if you're living off of 6%, you open up a whole new world to a whole new set of funds that you may and may not want to get into that are probably a lot safer than other funds. And there you go. All honestly, I said, hey, I'm going to have X amount in income and I'm going to have the rest of it in growth. What's wrong with that? People criticize it. They said, hey, you got Steven's book. You can't do that. Literally, I can do whatever I want to do. It's what I'm comfortable with. And there's nothing wrong with being 100% income. And there's nothing wrong with, hey, I have X amount and maybe these funds meet my requirement. Maybe I take the rest of it and put in JPIX or JPIQ because they pay less and they don't make my 8% hurdle, but they grow more. Maybe. I don't think that's the way I'm going to do it, but there's other ways of skinning those cats. And one way might be right for me. Maybe I'm comfortable with it. Maybe I'm not comfortable with it. But it's really what should be right for you. Now, I also had a comment this week about PDI. PDI, those letters. Link to an article down below. Before you go investing in PDI, I highly suggest you go read that article from one of those people on Seeking Alpha that I follow. It should be a free article. You should be able to read it and not be a paywall. So I highly suggest that you go read this article about PDI and what went on and why you may or may not want to invest in it. Just because somebody recommends it or talks about it, says they're going to put it in their portfolio, do your research and link to the article down below. You may or may not want to read it. It's very interesting what they said. So the summary of the week. A, we had the Santa rally. Love Santa rallies. Oh, backing up. Ooh. S-Fall. I love S-Fall. Starting to fall less in love with S-Fall. And there's some reason why. But if you didn't catch it, if you didn't sit behind your computer on Saturday night and look at their holdings, they changed their holdings again. They change their holdings as often as I change underwear. That's not true, but I just started throwing it out for some laughs. So they changed their holdings again. They used to have IVV, and it was a neutral position. And guess what? IVV is gone. Oh, look at that. IV is gone. So they've had 2 cuts in payments. I'm scheduling up a meeting with Eric to discuss what's going on with S-Fall. You're changing things again, and we don't like it. Honestly, I don't like it. My suggestion is hey, you hold 4 funds in that S-Fall right now. 4 or 5, 4. I actually put it in the Seeking Alpha. And they're all down this year. Every single one of their funds for the underlying is down. Forget about S-Fall being down. These are supposed to be safe, conservative income investments, and they're all down. So I gotta sit back and go, what are you doing? I don't understand how you can put money into your own funds and those funds are down. You're hurting the overall S-Fall. So I'm just going to have to call them to the table and say, things changing? They may change. Maybe they have a different view. We should hear them out, see what they said. I still love S-Fall. I still love how that works and how it functions, and you get the X amount, and I only need 8 so I can reinvest the 7. But at the end of the day, they need to have some funds that are at least neutral. How about not losing any money and paying out something? I mean, I can think of multiple ways they could do it, and maybe I'll make some suggestions, but I'm just a guy on YouTube. But the suggestion is don't have funds that lose 7% in a year and wonder why we're a little upset that the NAV is going down, because you're losing money. That's why it's going down. Come on, guys. Be better than that. That's my whole rant about S-Fall today. See what Eric says. I think Eric's a good person. I think he'll steer us right. He'll at least tell us the truth. And maybe we can make a decision later on. Do we stay? Do we go? But you can't have underlines that keep on falling down. Back to that Santa rally. Whoop, Santa rally. Go back up. So Santa rally happened. Good. Link to an article down below about Santa rally. Now that one's not free. I couldn't get a free link to it. It might be you can see it. It may not be you can see it. But there's a link to Santa rally. And this came from a Yale professor about Santa rally and how that works. So link below. After Christmas, the 10-year Treasury rose to 4.63. Okay. And the Dow fell 0.6. All right, so let's talk about this. So here's the problem with the Treasuries. This is the whole problem with Treasuries to begin with. Treasuries should be rates going down with the Fed cut. They're not. They're going up with the Fed cut. The market is literally telling you inflation is coming. Literally telling you that. I don't know why people don't understand that. That's why I got out of certain funds, CLTW, because that tailwind where they should be going the opposite direction and TLTW should be going up in price is going down in price because inflation, everybody's predicting inflation's going higher. It's in the treasuries. And unfortunately, Powell can't control that, even though he wants to. Hey, retail spending exceeds expectations. So congratulations to all those that have gone out and maxed their credit cards. Thank you very much. Makes us retired people a whole lot happier. Russia launches a full-scale missile on Ukraine. Yep. Okay. That is still concerning. And war is never good unless there's a recession, because then we need war to get out of the recession. There's never been a recession during wartime. But you didn't know that. There's a little tidbit. What recession during the wartime? That's because we pumped the economy full of money. And lastly, cryptocurrency, Bitcoin. The Fed and Chairman Powell got everybody upset, and we're consolidating around that 95,000. So there you go. That's what's happening with Bitcoin. So we'll see how that goes. Hey, economic rundown, the FOMC lowered the rates. And that's the question. Why are you lowering rates? Why are you lowering rates when you know, or you don't know, that inflation is still sticky? It's still sticky, ladies and gentlemen, but they're lowering rates. That's because I keep on telling you they have to roll the debt. And they can't afford to roll the debt. So they got to play the two-sided sword. And the labor market. Oh my gosh, the labor market. And I could go on and on for days. So somehow the labor market revised their predictions under Biden, since Biden's no longer going to be president. Oh, well, you know, we didn't gain 600,000 jobs. We lost 800,000 jobs. What? So anytime that they come out and do this stuff, it's all government horseplay. They're just pulling the wool over your eyes. They're just telling you whatever they want to tell you because they're just trying to keep you from being fearful. But hey, Santa rally. So usually, historically, Santa rally has driven December gains historically. Pretty true. Last 5 years. And it's a more recent thing than past thing. So more recently, that Santa rally has played a bigger and bigger part. And if you look at the performance of the S&P, you know, total returns are index percentage of positive months returns since 1950. 74%. Another interesting chart. I thought that was very interesting. But what they tell you is December through May is one of the weakest 6 months period in recent years. So also with the Santa rally, what they don't tell you, or what they expect you to know, is usually when there's a Santa rally, the next few months ends up being positive. Don't know. That's what the Yale people tell us. Maybe they've done their research. May be true, may not be true. But one thing that is true is consumer discretionary still leads the way when you look at the last 5 days and look at the last month. Now, I will say I found a fund that follows Dorsey Wright on this profile. And what they end up doing is going from consumer to technology to financial services to healthcare, and they will rotate the sectors. And I may start covering that for you on Sweet Tea, because that's going to be interesting to watch how they rotate sectors being cyclical in nature. So they do a good job on that in certain funds. Found that the other day. Thought it was interesting. Financial conditions eased since 2023, and that's what's stirring the crypto rally. Another chart, but those numbers correspond to this chart: Bitcoin versus U.S. financial conditions. And that's why you see the financial conditions getting weaker, ends up getting, well, it's not getting weaker, it's loosening up. And you see that Bitcoin price goes up when it does. Another interesting chart. Mag 7, go Mag 7, 34% of the S&P 500, just 7 companies. So that's an interesting thought that 7 companies are such a large part of the S&P 500. That means the rest of the companies really don't count. Just throw it out. See the reaction. Where you take the Magnificent Seven and is 1/3 of the S&P 500. To get away from the concentration risk, you look at small caps, and small caps surge. You can see the line. You can see how small caps go up over time. It's not consistent, but it is trending in the right direction. And you never know what's going to happen with the new president coming in. Which brings me to the new president coming in. Oh my gosh. And we're not even going to say his name. We're not even going to say his name. Don't want to get banned off of YouTube for saying his name. The problem with it is we don't know what he's going to do. We don't know how this is going to affect you and I. Just throw it out. Where his tax policies go through, will he be able to extend the tax breaks? Because the Tax Cuts and Jobs Act expire in 2025. Will he be able to extend that? Maybe, maybe not. Right? Financial stimulus from tax breaks. And this is what has Chairman Powell. This is what has Chairman Powell all upset. Will tax breaks affect his policies? Now, historically, it doesn't really matter. As they lower taxes, they end up getting the same amount of money either way for the federal government. I think I've shown that chart in previous slides. So when they lower it, economic goes up. It's all gameplay. It all ends up washing out in the long run. But we still can't afford our debt. So Chairman Powell doesn't know what he's doing. Because he doesn't know what the other guy is going to be doing. Okay. Well, they'll figure it out one day. But one thing is for sure is the financial markets often struggle in aggressive monetary policy years. So having less rate cuts may be a good thing for the economy. Not my chart, just passing on the information to you because it's interesting how they're doing things. Hey, lastly, we're going to get down to Seeking Alpha. I'm attending the virtual investing forum. They will be talking about income stuff, but they're going to be talking about growth. How have they done recently? Well, they've done well. They've picked another one that's returns of 17% to the total portfolio since November with Carnival. So it's out there. They're doing what they're doing. But personally, I look at this going 2 different ways. You can invest all in income and you will be just fine. And later on in life, as I get older, I will probably go more and more to income. But I only need so much money today. So why would I have a whole lot of income coming in being capped? That is the whole conversation. You get capped. That's what a cover call does. You get capped. You should not have, if your goal is to become rich, Misty being capped is going to underperform MSTR. It just does. But somebody will say, oh, Misty, and it's just like, oh, you don't understand. So in a sideways market like we're having now, Misty will outrun MSTR. But in a violent up movement, MSTR will always outplay it. So I don't get where people are always thinking about income. understanding that basic of we get capped, and then they'll cry about getting capped. That's the best part. Then they will cry about getting capped, but they got capped because they were in it. But they'll cry about it, and then they'll tell you the only way to get rich is to be that way. Don't get it. So 30% more. So if you need 100,000, set your goal for 130. Fidelity makes it fairly easy that you can go through your investments and see down in the bottom right-hand corner exactly how much you're going to get in revenue, even though you got to have at least 1 year's worth of data. So AIPI doesn't show the right numbers, so you can have to do it in Excel, unfortunately, for those newer funds, because there's not enough data to calculate it out. So hopefully that's something to think about. If you need you need 60,000. You should probably have an income of 78,000, and then have the rest doing something else for you. And again, there's nothing wrong with putting some of that maybe in JPIX. Doesn't pay my 8%. It's a whole lot safer. It'll grow over time, and it has a little bit of income, just in case you have an emergency or something like that. Don't know. Don't know your financial position or conditions. That's why I can't give you financial advice, because I just don't know what your conditions are and everything else. Between that and I don't have my Series 65, right? Got to have that before you can do that. And although you could be a financial coach, that's the best part. That's the best part. You can be a financial coach and you don't need your Series 65. That's a different aspect. Something I've thought about, because I'm not recommending or selling products, but I could be a financial coach, and that's the difference between the two. Anyway, hopefully you enjoyed this episode, me rambling, and until next time, God bless.